The modern world runs on a lie so old we stopped questioning it. The dollars in your pocket, the digits in your bank app, the paycheck you wait for every month, none of it is truly money. It's debt disguised as wealth, a promise written on sand. And for centuries, that illusion has quietly shaped who holds power, who stays free, and who never escapes the game. To see how that trick began, we have to go back to the moment money stopped being real. In medieval Europe, money was metal, gold and silver coins, stamped by kings, carried across dangerous roads in leather pouches. Wealth was heavy, hard to steal, but harder to move. The rich soon realized that goldsmiths, craftsmen who worked with precious metals, kept secure vaults. So people began leaving their coins with these goldsmiths for safekeeping. In return, they received handwritten receipts, notes that promised the bearer of this paper may reclaim his gold at any time. It was a simple contract. Then, something strange happened. People began trading the receipts themselves instead of the coins. The paper was lighter, easier to carry, and everyone trusted it because it represented real gold sitting safely in a vault. That's when the goldsmiths noticed something. Hardly anyone came to collect their gold. If they had 100 clients, maybe 2 or 3 showed up in a week. The rest of the gold sat untouched. And with that realization, a new kind of power was born. The goldsmiths began issuing more receipts than the gold they actually had. They could lend out promises on gold that didn't exist, charging interest and earning wealth from nothing but ink and trust. As long as everyone didn't demand their gold at once, no one noticed. But in that simple loophole, the modern financial system was born. Fractional banking, creating money that isn't really there, became the secret engine of economies. By the 17th century, kings and governments adopted the same trick. Wars were expensive, and the crowns of Europe were drowning in debt. In 1694, the Bank of England was founded, not to protect savers, but to fund the government's endless wars. It loaned vast sums to the crown, money it didn't actually possess, by creating new notes backed only by faith and taxation. The promise was seductive. The government could borrow endlessly, and the people would pay the interest through taxes. Every citizen became collateral for money that never truly existed. Across the Atlantic, the same pattern emerged. Early American banks issued paper banknotes supposedly backed by gold, but they learned the same lesson. As long as the public believed the paper was good, the gold didn't matter. More notes meant more loans, more interest, and more profit. But belief has limits. When fear spread and people demanded their gold, the illusion collapsed. Banks failed. Fortunes evaporated overnight. Each crash revealed the same truth, that the system's wealth was only as real as public confidence. Instead of ending the trick, governments institutionalized it. In 1913, the United States created the Federal Reserve, the central bank meant to stabilize the chaos. But in practice, it made the illusion official. From that day on, the creation of money no longer required gold. It only required debt. When you deposit $1,000 in your bank today, it doesn't sit there waiting for you. The bank keeps only a small fraction, sometimes nothing at all, and lends the rest. Those loans create new deposits in other banks, which lend again, multiplying the same money over and over. Your $1,000 might become $9,000 circulating in the system, but only a tiny slice of it exists as real cash. The rest is numbers, promises, and debt. Every dollar in circulation is born from someone signing a loan agreement. Every mortgage, credit card, and government bond adds to the money supply. And every repayment destroys money, pulling it back out of existence. That's the secret most people never see. Money doesn't come from wealth. It comes from debt. This system has 3 unavoidable consequences. The first is inflation. Because banks keep multiplying credit, the total supply of money grows faster than the goods and services it can buy. The value of each dollar slowly erodes. Inflation isn't a policy mistake. It's baked into the design. The second is perpetual debt. Since all money is created as loans, there is always more owed than exists to repay it. Interest ensures the total debt must keep growing forever. If borrowing stops, the economy shrinks. If debt is repaid faster than it's created, the money supply itself collapses. The third is concentration of power. Those who control credit, banks, governments, and asset holders, gain control over everyone who needs it. The wealthy own assets that rise with inflation. The poor rent, borrow, and lose purchasing power year after year. Debt becomes the invisible chain linking every worker, business, and nation to the same machine. When the illusion falters, history rhymes. In 1929, the U.S. stock market boom was fueled by easy credit. Investors borrowed to buy stocks, banks lent beyond their reserves, and optimism replaced logic. When confidence broke, the system imploded. The Great Depression wasn't just a market crash, it was a banking collapse. People tried to withdraw real money, only to discover it didn't exist. Fast forward to 2008, and the pattern repeats. Mortgage debt ballooned into a $10 trillion bubble, chopped into safe securities and sold around the world. When borrowers defaulted, the house of cards trembled. Banks faced insolvency because their assets, those loans, were illusions of future repayment. The response was the same as always: print more money. Central banks flooded the world with new credit, bailing out the system that had failed. The illusion survived at a higher cost. Today, that system is more fragile than ever. Since 2020, U.S. banks are no longer required to hold any reserves against deposits. Zero. Money creation now depends only on regulations written in Basel, Switzerland by unelected technocrats under the Basel III framework. These rules don't limit lending directly. They simply require banks to prove they have enough capital to cover losses. But capital itself is often just accounting entries, paper assets valued on faith. Banks no longer lend from deposits. They lend first, and the deposits appear after. When you take a mortgage, the bank types new money into your account. That's not money they had, it's money they created. The act of borrowing itself adds to the money supply. And that's the uncomfortable truth. In today's world, over 90% of all money is created this way. Not by central banks printing bills, but by commercial banks creating credit. If everyone paid off their debts tomorrow, the money supply would collapse. Banks would have nothing to lend, and economies would seize overnight. The system depends on your willingness to stay in debt. That's why governments encourage borrowing through low interest rates, stimulus programs, and endless credit expansion. Debt isn't just tolerated, it's required. Meanwhile, inflation quietly taxes everyone who holds cash. The value of savings erodes, pushing you back into the system, borrowing, investing, or spending to stay afloat. And yet, despite centuries of warnings, we keep believing. Because belief is what makes the illusion real. Every major crisis in history, from the tulip mania of the 1600s to the dot-com bubble to modern crypto speculation, shares the same heartbeat: expanding credit, chasing limited reality. Each new generation convinces itself that this time is different, that human ingenuity can outsmart arithmetic. But the math never changes. You can't build infinite promises on finite trust. Rome learned it when it debased its currency to pay soldiers. France learned it when the printing presses of the Revolution destroyed the assignat. We learned it in 1929, in 2008, and we'll learn it again when the next cycle turns. Because the system isn't built to stop, it's built to reset. When debt grows too large, confidence breaks. Then governments and central banks step in to save the system, creating even more debt to patch the old. The cycle restarts at a higher level, more credit, higher prices, and greater inequality. It's a loop that only ends when faith itself runs out. So what can you do in a world built on debt? First, understand the difference between money and wealth. Money is a claim on wealth, not wealth itself. Real wealth is what remains when the system resets. Land, resources, skills, and independence. Second, recognize that inflation isn't an accident. It's the silent fee you pay for the privilege of living inside a debt-based economy. Third, remember that confidence is the true currency. As long as people believe in the system, it works. When they stop, everything changes, fast. If history teaches one lesson, it's that financial empires fall the same way they rise, suddenly and then all at once. The medieval goldsmiths discovered a trick that reshaped civilization. Banks perfected it. Governments weaponized it. And now, every one of us lives inside it. The hidden system that turns debt into money isn't just an economic structure. It's a philosophy. It rewards trust over truth, borrowing over saving, and illusion over reality. But the moment you understand the trick, you're no longer trapped by it. You start to see that money is not security. Freedom isn't the size of your balance. It's your ability to survive without it. Because when the next crisis comes, and it will, the system will do what it's always done: protect itself. The question is whether you'll be one of those holding paper or something real. If you want to understand the next collapse before it happens, don't just watch history, learn from it. Subscribe and stay with us as we uncover the patterns behind every crisis, past and present. Because the next shift in money and power won't wait for anyone to catch up.